Well, on Star Central today, we're also going to put the spotlight on digital payments. It's a hot new space. You've recently seen suggestions from the Reserve Bank of India also when it comes to the regulatory sandbox. You've seen a whole host of companies come out with how credit offtake is only increasing, and that seems to be the case only with the startups, mobile wallets, etc. I wish the traditional banks would be showing similar data. I'm going to now go across to someone who understands digital payments really, really well. He's worked very, very closely on that while keeping data safe, talks about all of that. It's Sahil Kini joining us. He's, of course, since then co-founded Setu as well. Sahil, welcome back to Startup Central. The last time I interviewed you, you were in New Delhi. Be happy you're in Bengaluru because the air here is not worth breathing. We are in a gas chamber. But having said that, today we're bringing you here to talk about digital payments. You've been talking a lot about it. You've written a couple of columns. So I thought it's a good time to get you on board. But because if we don't have, the case you're making is that if we don't have entrepreneurs like yourselves, if we don't have startups like you, we're going to see Bharat being completely neglected.
Right. I think what's becoming very clear is that the banking 1.0 was when you had to kind of go to your bank branch and you had to do passbook entries and do that kind of stuff. I was born slightly. I mean, I kind of grew up in the age where branch banking slowly started kind of fading away. I've not made a passbook entry, I don't think, ever, and started transacting on banking applications. So you and I typically do net banking or mobile banking. But what's been kind of what's happening now is that mobile banking is kind of moving even further down into the chain. We have now 400 million people with smartphones. What that means is basically the mode of transaction and the bank itself is going to go into the mobile phone. And to take that even further, the banks have to now enter every single application. That's what's really needed at this point, because expecting people to open a bank application and do all their transactions only on the bank's property is something that I think is a declining trend. If you see the leading payments apps in the country, these are apps like PhonePe, Google Pay, Paytm, etc. None of these are banking applications, and yet they transact with your bank account. And I think that and not just me, I think people who've been working on these kind of platforms, be it UPI, be it the account aggregator platform, or the India stack as a whole, what we're seeing is a movement where banking and transactions and banking data is moving closer and closer to the customer and going into the apps that the customer or the user likes to use. And that is a major shift that I think is going to occur over the next 2 or 3 years. We're already seeing that with RBI releasing the account aggregator specifications, which will allow you to access banking data. So soon the bank will enter the customer's apps, and customers should be able to enter.
But, I also want to then talk about another problem that exists. And, Sibyl, for example, has come out with certain data talking about that could millennials be leading to the next crisis because our proper background checks being done. Sahil Kini, you over the weekend also wrote a column where you said two kinds of people never go to banks. One is the English speaking, which clearly you were making a joke about that. And the second one was those out of the traditional formal sector, whether it's our vegetable wala, our rickshaw wala, our milkman, the kirana wala, and all of that. But the fact is that when we look to service this, and as part of Banking 2.0, how important is that going to be, that you're going to be able to service the debt? Or is that taking a back seat for now?
No, it cannot take a back seat because, you can treat lending as something that is easy to do when you're giving the money out, but it really turns into a business when you have to start collecting money. So what ends up happening here is, it's not just about background checks, it's about the entire process, right? So it's onboarding cost, it is the loan servicing cost, which is making sure that you're collecting efficiently and collecting on time, and making sure that you're able to also get the data about the customer to be able to do what you're referring to as background checks, but essentially assessing the credit risk of an individual. And see, today, most of this process is still offline. It's still kind of paper driven. That's because all these financial institutions typically enlist the services of intermediary organizations. Refer to, I mean, these could be DSAs or direct selling agents, this could be brokers, other types of agents, etc. And they go through this offline process where they collect your KYC documents, your bank statement, your whatever, your CIBIL score, all the other things that you need to qualify for a loan. This process, when it's offline, is quite expensive because they have to come see you, and that costs money, and they have to take Xerox copies or photocopies of your documents, which cost money, and then go file it in the branch. And when the collection process also, if your automated mandate fails, again turns into a process where people are calling you to remind you to make a payment. So each of these things currently adds a considerable amount of operating cost to the economics of a loan. The only way to kind of make formal finance accessible to the people that we spoke about, people like our security guards and people who sell vegetables to us and people who are essentially in the next 500 million. The only way to do that is to dramatically reduce the costs associated with customer acquisition, with operating, with servicing a loan, and with collections. And the only way to do that is to go fully digital in a way where through someone who already has a transacting
Point, Sahil.
relationship. Through someone who already has a transacting.
No, no, Sahil, I take your point that, you know, how we have to reach the next 500 million, how we need to bring down the cost, and how fintech companies and digital companies are going to play a very good role in that. My other question to you was that how do we prevent a CDO crisis in India? How do we make sure that all those that we're giving debt to will be able to service the debt, that we don't have another financial problem on our heads? That's the question I'm asking you. Are fintech companies braced for that? Do they have enough data? Because otherwise that's going to be a huge problem with a domino effect.
So I think there are two aspects to the question that you asked. One is, of course, on assessing credit risk. So the question that you're really asking is, are the people that we are lending to credit worthy? And will they be able to kind of repay the loans that the startups and the lending startups are giving them? Now, obviously, I have not looked at their loan portfolio, so it's hard for me to tell which ones will do well and which ones won't. But if you kind of do an informal check, in my previous avatar as a venture capitalist, I had the privilege of basically evaluating multiple kind of lenders. And we do see that whenever a lending company tries to grow too quickly, it tends to almost violate the laws of financial physics, if you will, because when you're chasing it all depends on what number you're chasing. If you're saying that the only number that matters to me and my investors is the size of my loan book, without paying attention to the quality of your loan book, without looking at your NPA numbers and your leading indicators very, very carefully, then what happens is unrestrained growth, and that can be very, very risky. So often, whenever I used to evaluate lending companies, I would look at their growth rate, and if it was too high, that would be a bit of a orange flag for me for sure. And I would look at how were they able to grow so quickly? Is that growth sustainable? And these are questions that I would expect any responsible investor in a lending company to ask this question. That is the first aspect. The second aspect, of course, is on product design itself. If you're giving the same type of loans that you would give to a salaried employee with a high income to someone who is got irregular income and expect the same repayment schedule to be met, then you're going to have defaults, which is one of the points that I made that's flashing on your screen right now, which is if you expect monthly repayments from someone who does not have monthly income, then you basically set up that particular borrower to fail, because they won't receive money in their bank account in time for the repayment to occur. Different people receive income in different schedules, and loans should take into account the cash flow curves or the income curves of the borrower before saying that this is the repayment schedule. My problem is that the design of our financial products is not suited for the next 500 million. And for that, we'll have to think very hard about what is the size of the loan, how should we ask for repayments, what kind of flexibility do we offer. And I think that will also go a long way in managing risk.
One is, of course, designing the new product. The next question is of reach, which, I think data penetration and what the government's own drive is with Jan Dhan and financial inclusion, and all of that is going to take place. What else has been your other big suggestions when it comes to making sure that Bharat is indeed banked? Pardon me for asking you this, with what we are seeing, the exuberance on the fintech space, is it RBI keeping pace? It has, for example, come out with suggestions recently as far as Sandbox goes.
I think, see, the RBI is doing everything it can to kind of keep pace with these lenders, and lots of people are working with the RBI. Lots of think tanks like iSpirit, the think tank that I kind of volunteer with, and several others are advising the RBI on figuring out what kind of platforms will help them monitor this stuff more effectively, which is partly why the RBI also launched something called the PCR, the Public Credit Registry, which should make it easier for lenders to get more current information on the borrowing status and the credit worthiness of a borrower. Currently, credit bureaus don't refresh the information often enough. I think the refresh rate is between 60 and 90 days, actually between 30 and 60 days. So what that means is if you borrow multiple times in that time period, that data doesn't necessarily reflect when you're doing a CIBIL pull. So you want information to be much more current, which is something the RBI is doing. I think the RBI also can do a lot more work on monitoring the performance of all the lenders on a more regular and granular basis. That's a bit harder to do, but if everything moves to digital platforms and all reporting is done through APIs, then instead of expecting a company to send you a monthly report or a quarterly report like the RBI does right now, the RBI, the regulator, should be able to kind of dynamically have a dashboard of how each lender is performing over at any given point in time. And I think that's the direction that we're moving in over a 3 to 5 year period. With all this fundamental infrastructure in place, the regulators should be able to conduct their job much more effectively. The other aspect to kind of keep in mind is essentially figuring out the context in which credit is given or insurance policy. And it's not just about loans, right? We are not only underbanked in terms of credit, but we are underinsured and we don't save well enough. So all the licensed financial institutions will have to find a way to distribute their products through multiple channels, through all of these applications, and being able to a simple example of a good product, a good kind of new age product is ₹1 ride insurance that Ola offers in partnership with the digital insurer Atco. If you think about it, there's no other product like it in the market. 1 million insurance policies are created every single day, and each policy lasts only for 20 to 40 minutes, which is the average length of a ride, right? So you're insured only for that time period for when an accident happens or if there's a delay, etc. So that kind of product will increase insurance coverage. You can think of insurance for pretty much anything that has a chance of going wrong, so that the downside is covered. Investments, again, can you make an investment so that there's a US startup called Acons, which essentially takes, it rounds up the money. Let's say you made a purchase for 98 rupees. It rounds up the money to say 100 rupees and then puts that 2 rupees in an investment account. So I think what India really needs going forward is simpler products, almost what we call, internally we refer to it as self-driving money, right? Basically making the best kind of choices for the consumer, or at least suggesting only the best choice to the consumer, and providing other options only if the consumer asks for it, right? So if there's a loan, you don't need to see 50 loans to decide what is the best loan. The average consumer is not a qualified financial advisor to evaluate, the 30 loans that you'll see in Bank Bazaar and say this one's the best one for me.
I got your point.
Yeah.
Okay. Sahil, it's always a pleasure chatting with you. We'll get you back as soon as you write your next column on banking for Bharat, and of course with your partner Nikhil as far as Setu goes, and whatever it is that you guys are planning there. Always a pleasure having you on Startup Central.